Welcome to Mad Money. Welcome to Cramer. My friends, hey, I'm just trying to make a little bit of money. My job is not just to entertain, it's to teach. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. It's starting to dawn on people. A market that only goes higher because of data center spending is a perilous market. And we don't like that. Increasingly, I feel like there are better places to hunt for winners than the AI space, where many, not all, but many feel picked over. And that's why today the Dow jumped 327 points, the S&P advanced 0.06%, but the Nasdaq declined 0.26%. It feels like the revenge of the nerds, people, with the nerds this time being reasonably priced stocks of companies that don't need trillions of dollars of data center spending to pan out and aren't usually found on the Nasdaq. Before you sniff at the pedestrian nature of today's leadership, the bulls should be gratified, at least the ones among you. See, if this were a bad market, the weakness in the data center related plays would have sent everything down. The fact that instead we had a rotation into lots of other groups show you this market has tremendous strength. Instead of everything being dragged down by tech, we got a market that defies the bears and has come up with a ton of undervalued companies that could catch fire now that the government shutdown finally coming to an end. It's gotten broader, and broader is always good. First, the travel stocks came roaring back. The battery airline stocks, United and Delta, have found their way back into the winner's circle. Same goes with Expedia. The end of the shutdown will stop the price target cuts right in their tracks. When we see these travel stocks come back to life, you can expect similar gains from the cruise lines and the hotels. Dude, there's a whole group of analysts just itching to come out here, cover these stocks. They've gone silent because of the decline in consumer confidence, some weak bookings numbers. But now that the government's about to reopen, do you really believe these analysts won't immediately start turning positive tomorrow morning? Hey, Marriott had a terrific quarter. Why not just get out from under the desk and push that one? And which casino analyst can resist pushing the now in favor Wynn Resorts, especially when China's starting to get stronger? Losing that post-COVID travel thesis has been brutal, hasn't it? Good to have it back. It's been at least a week since someone has urged their clients to buy the stock of American Express. I know it's counterintuitive, but you believe this stock's already at an all-time high today? That's perfect because everyone likes a good price target boost. How can you not raise the price target of American Express when it's never been this high?
House of pleasure.
Let's not forget the second-day thesis for travel includes the aircraft themselves. Last week, I heard from Larry Culp. He's the CEO of GE. During our sojourn to Harvard Business School, their business is remarkable. But that terrific quarter was buried by the government shutdown. Oh, and how about the fact that Boeing's making a comeback with its cash flow, yet all its stock does is go down? That's worth an analyst crawling out from under her foxhole, saying good things, even if it's below the 50-day or the 2-day, I don't know, the RSI, MACD, anything. Glum people don't go out to dinner, do they? They hunker down and stay home, all bummed out, eating ready-made salads and whatever else they can afford from the supermarket without breaking the bank. That's been a problem for millions of people with the federal employee furloughs and the food stamp cuts, stuff that makes us look like a banana republic, except I think that that's an insult to the apparel chain, which is part of a broader turnaround at the Gap, by the way. Another stock inching higher after a quarter I felt was pretty good. What else? I see a trio of restaurants that have been down on their luck starting to make moves here. Brinker, symbol Eat, Texas Roadhouse, and Chipotle. I know these moves are nascent, but Brinker, the parent of Chili's, reported a terrific quarter. No one seemed to care because of the shutdown. They care now. Texas Roadhouse missed the quarter because of beef inflation, not because of traffic. The actual traffic, the customer count, was astounding given the shutdown and the steak inflation. Chipotle, it's doing some rivalry week, buy one, get one college promotion. Perhaps that's the hook they need to breathe new life into one of the worst stocks in the world. All I can say is, hey, when does Harvard play Yale? Let me throw in one of the more despised stocks out there, maybe the most, and that's Starbucks. Excuse me for liking that last quarter and the move to coordinate the price of coffee, even if it's a minor portion of the overall cost structure. You can push Starbucks return of the Oh, and here's a staple. When people want to go out to dinner, analysts think they always had the Olive Garden. So you need to go buy OG parent Darden. From what we've been hearing about consumer confidence, you'd think that the Grinch had already stolen Christmas pretty early, huh? But with the shutdown ending, It's a fantastic time for retail analysts to get on the horn and pound the table for the usual suspects, especially with the sudden collapse of oil. Swiss shoemaker On Holdings reported a remarkable quarter and guided for no discounts this holiday season. Strong demand. That upside surprise should be enough to send some retail analysts to the morning meeting to say, we hear good things about footwear. How can they not do that? They can't let someone else do it first, right? You got to justify your job. So just go recommend Dick's, the big seller of sports footwear, among other things. Let me make it easy for these analysts. Jar their memory. The following retailers were doing well before the shutdown, so they're worth reminding the clients about. Urban Outfitters, which had one of the best quarters we've seen in ages. Macy's, which is about as low as you're going to get after 10 times earnings. Come on. Even as the stock's within spitting distance of 52-week high. And would it be too much to recommend Costco down more than 150 points from its high and now despised? I don't think so. We've heard enough about how much money Sam Altman from OpenAI is going to need to borrow in order to finance hundreds of billions of dollars of spending commitments. This CEO, by the way, is like a one-man borrowing machine. He's created demand for loans from everyone, including those who might not even know they're making the loans. In the meantime, the bank stocks are absurdly cheap versus the rest of the market. The SEC has been on partial hiatus during this fiasco of a shutdown. Can you imagine the pent-up demand, the huge amount of IPO filings that Goldman Sachs, Bank of America, JP Morgan, and now the feisty Wells Fargo have to do? It's enough to make the quarter. Even more so, I expect deals galore between here and the end of the year. Who can resist when we have an antitrust department that perhaps should be called the pro-trust department? Hey, who's that pro-trust? Finally, let's give a nod to pharma. We had Amgen on the show the other day announcing a breakthrough in Repatha. It's every other week injection, squelches cholesterol to a level where it helps prevent heart attacks. Why not go by that? Pfizer, hey, getting into the most lucrative business in the world, weight loss, with the acquisition of Betsera. And Lilly's knocking on the $1 trillion door with a pill form GLP-1 drug rivals. You know what? Who needs diet and exercise? But those are actually good for you, too. Here's the bottom line. This market could have been eviscerated today, now that the year of magical investing is coming to an end. Instead, we're watching the money flow back from OpenAI and company, even though that's private, into the rest of the economy, the part that doesn't need a federal data center backstop if the AI thesis goes awry. Welcome back to growth investing non-tech style. We missed you. And thank heavens nothing needs to be built out for these stocks to run. The building's already done. Spencer in California. Spencer.
Jimbo, thanks for taking my call.
Oh, absolutely, Chief. What's shaking with you?
All right. I've been watching you for all 20 years of Mad Money. I come home from school as a kid every day and watch a show with my dad, Ken. Now I've finished my med school and anesthesia residency in the last few years. I'm finally making some money, and I'm ready to put that money to work with your help.
I'm loving this. Let's go to work together.
All right. I'm on chapter 14 of your book, learning about how to read balance sheets. The company I'm looking at had a less pristine than usual balance sheet this quarter and dropped about 25% after earnings. Is this a good entry point for Celsius?
I was surprised about that miss, and frankly, I didn't understand it. I have been behind Celsius. I almost include a big part of my book about Celsius. Thank heavens I actually didn't get in because that was a bad miss. I think that we have to wait another quarter. I'm sorry. That miss was not good. Got to call it like I see it. Stafford in California. Stafford.
Hey, Jim, how you doing?
Real good. How about you, Stafford?
Good, thanks. I want to get your thoughts on Deere stock, John Deere.
You want my thoughts on Deere? No matter what happens in the country, we are a country where farmers get checks. And I think that's great because I want them to keep farming. And what do you do when you get a check? You buy a Deere. All right? Look, the market could have gotten clubbed today beyond recognition now that the AI trade's finally rolling over. But the rotation into stocks representing the real economy is keeping us afloat. I like it. I like growth investing non-tech style. On Mad Money tonight, Flutter Entertainment's in the move after reporting good earnings. I'm getting the latest read on the sports gambling space of the parent company, as you know, is FanDuel. Then AMD soared 9% today on the heels of its analyst day. I'm breaking down the highlights and where I think this stock could be headed next. Plus, we got private player Databricks on, and they've been capitalizing on the AI boom. I'm checking in with the company's top brass to see if an IPO might be on the horizon. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What do we make of these numbers from Flutter Entertainment, the parent company of FanDuel? After the close, this online sportsbook reported what I call a mixed quarter, with soft revenue thanks to some adverse gambling outcomes, but also higher than expected earnings. At the same time, Flutter announced that it's moving into the predictions market, much like we heard from DraftKings last week. Their platform, FanDuel Predicts, is launching next month in partnership with the CME Group. Now, does that change the equation for an industry that's had a tough year? Earlier tonight, I got a chance to check in with Peter Jackson, CEO of Flutter Entertainment. Take a look. Mr. Jackson, welcome back to Mad Money.
Jim, great to see you again. Thank you for having me on the show.
Well, I'm absolutely thrilled you're here because we have a long-standing relationship with you from the days when I know you were fascinated by Mad Money. I am so happy for all of your success. This quarter, despite what you call competitive dynamics that allowed where customers got generosity from your competitors, you still managed to beat the bottom line. How were you able to do that?
But we're really pleased with Q3. It was a very solid quarter for us. Revenues for the group were up 17%, including our recent acquisitions in Italy and Brazil. In the US market, revenues up 9%, really driven by iGaming, which is up 44% year over year, which is just terrific. We also announced today we're very excited to be launching prediction markets next month. And look, we got off to a great start in Q4 as well. We're very, very bullish and confident about the future.
Now, let's talk about the predictions market, which is a market candidly I am fascinated by, but I was always hoping someone would actually have a partner from our world, not just a partner from, say, Vegas. You've got the CME, whom I regard as the foremost arbiter of this kind of activity, as your partner, which to me legitimizes something that I felt, frankly, is a little bit, that I was a little sheepish to be involved in.
We've been operating in this space for a long time, right? We have the Betfair exchange in the UK, in Italy, and another number of other markets around the world. We've run for 20 years. So we've got lots of experience. But when I met Terry in January this year, I knew we could hit it off and form an exciting partnership. And we're really pleased to announce today that FanDuel Predicts will be live in December. So our customers in the half of America who can't currently access the FanDuel Sportsbook can now access the sports product and use what's going to be the best products we'll have available in prediction markets.
Now, you do not have to have any of the traditional gaming licenses in say, Florida, Texas, and California in order to be able to bet on games, correct?
Well, you're absolutely right. So prediction markets are regulated by the CFTC. And in our partnership with CME, we're going to be able to make these products, the sports product, available in all the states where FanDuel does not have a sports betting license. So if you're sat there in California today, watching the FanDuel ads on TV, you're going to be able to download the FanDuel Predicts application in December and start using the sports product. So we're very excited about it.
I think it's going to be huge. It's going to equal the rest. Those three states can equal the rest of the country. Now, I do want to know, so I've been in Britain and been fascinated by the queries about what people bet on, but did they get tired after a while, or do you think you can keep them fresh? Because I did feel they got stale over there.
The Betfair exchange, which is something we've had for a long period of time, it's not in the same ballpark as a full-fledged sports betting platform. There's a much richer set of content you can find through parlays. You can have generosity available. But look, if you're sat in California today, you can't have any of that at the moment. So FanDuel Predicts is going to be a great product. From a sports perspective, you're better bet on all of the major leagues. We'll have soccer there for the World Cup next year as well. And then across the whole of America, there's going to be the financial markets, which you'll be familiar with from CME, that all of our FanDuel customers will be able to have a go on as well.
Now, will there be separate pages? Let's say I go to my Flutter page. Will I also have predictions right on the same page?
It's going to be a separate app to start with. So FanDuel are going to launch the FanDuel Predicts app. It will be a separate standalone app. There's complexity around sort of commingling of balances and stuff at the moment. So we'll launch that product in December. So, if you're sat in California, you better download it, access the FanDuel Sports product straight away. If you're sat here in New York like I am today, you better actually access the financial markets. But we're not going to have the sports product available in any of the states where you can access the FanDuel Sports betting app.
Okay, because I like to toggle back between, say, the FanDuel page and with the same bank, but I know there seems to be some law which says you got to have separate banks or separate pages because it's just so much quicker. But you'll have to have that right now for California. It's not going to be the same account or bank.
That's right. So in California, you'll download the FanDuel Predicts app, and you'll better access from December all of our sports product together with the financial markets and the other novelty markets will make available.
Okay, right at the end of your letter, you mentioned something. I know that there's betting in cricket where they bet on everything. They bet on every pitch. They bet on every. I mean, they're so much fun. It's just crazy because it makes the game so much more interesting. But I see that outside performance in the quarter, you said the enactment of the Promotion and Regulation of Online Gaming Act in forced Junglee and other operators to immediately cease real money work there. Can we not do that anymore?
Look, in India, we were very disappointed that we had this. This came out of the blue, and our business there offered rummy, right? So we were not doing sports betting in India. It's illegal, but we were one of the biggest rummy operators in the market. They came out with this new rule, so we had to shut down our real money operation. Look, fortunately, we're a very diversified business. We've got a lot of operations, number one positions in many markets around the world. And so the business has got very strong foundations. It just shows the importance of scale and diversification.
All right, fantastic. And one last thing, I know that the predictions market, I think you can revolutionize it. I think because you're so big, you've got the huge market share. Are people allowed to suggest things to you that we want to bet on?
But to start with, we're going to have a range of products available. We'll launch this of combo bets in early next year, and we're convinced we'll have the right ingredients to win in prediction markets in America. We can leverage our expertise. We come out of Betfair. We've got our fantastic brand, and of course, I think we've got the best partner with CME. So we're going to have a winning proposition. We're going to put a lot of money behind it in a disciplined way, but we will win in America like we have done in sports betting and iGaming.
All right, don't laugh, but what I really want more than anything, because I happen to love them, I do them, can we get predictions parlays?
Look, these are some of the combos which we believe we'll be able to have available on the platform next year. So watch out for this, and look, you'll be able to bet. You'll better take a contract out in your beloved Eagles, and let's see, even when you're in California.
Well, you've read my mind. I was in California last weekend, shut down for what I knew was going to be a very important game. Well, anyway, you know me, and I know you, and I love your company, and it's just a terrific thing that you're doing, and it's going to be a very big splash. I want to thank Peter Jackson, CEO of Flutter Entertainment. Thank you, Peter. Thanks for coming back. I really love it.
No, thanks for having me.
Of course. Man Buddy will be back after the break.
Coming up, chipmaker AMD is seeing a surge after its analyst day. But can the company and the AI sector keep up the momentum? Cramer is giving you his take next.
Last night, AMD, the big chip maker with that huge artificial intelligence exposure, they held an important analyst meeting right here in New York City. You never know what you're going to get from these analyst events. I mean, sometimes they're snooze fest. Sometimes it's a big deal. This one was a huge deal, which is why AMD's stock shot up 9% today. Now, AMD's already had a phenomenal run, with the stock catching fire last month when they announced a massive deal with OpenAI. They're selling OpenAI 6 gigawatts worth of GPUs as part of a multi-year agreement. Now, we don't have specific numbers, but management says the deal will be worth tens of billions of dollars in revenue. In less than 4 weeks after the announcement, the stock shot up 62%, falling to a new all-time high of $267 and change. Big. After that, though, AMD pulled back hard as the entire market seemed to turn against the AI data center space. Even when the company reported a strong quarter last week, it barely got credit for it. Stock gaining 2.5% in response last Wednesday, but still finishing the week deeply in the red. Still, going into last night's analyst meeting, AMD was up nearly 100% year to date, so it felt like the onus was on management to justify this colossal move right here. And you know what? They did. CEO Lisa Su laid out how far AMD's come in recent years, taking share of both CPUs, that's really from Intel, for the PC, and GPUs for the data center. And yes, that is share from NVIDIA. Overall, the company's data center revenue has gone from $2 billion in 2020 to more than $16 billion this year, now accounting for nearly half of the business. At the same time, AMD's had big success in its PC gaming and embedded systems businesses, including chips for cars and surgical robots, smaller but important. Of course, this is very much of a what have you done for me lately market, so let's focus on what AMD had to say about the future. Management rolled out what it calls the 4 pillars of the strategy going forward that want to extend their compute technology leadership, expand their data center leadership, open up software platforms and developer enablement, and power AI everywhere. On the technology leadership front, AMD talked about their positions in CPUs and GPUs, but they also mentioned they've gotten into all sorts of auxiliary products like networking and interconnects and advanced packaging. I think they made a very good case for why AMD should be considered a technical leader among the universe of semiconductor companies that are not named NVIDIA. In terms of the data center, AMD said they expect the total addressable market, it's called a TAM, to expand at a 40% compound annual clip, growing from $200 billion this year to north of $1 trillion in 2030. They're talking about doing 10% market share in AI semiconductors and networking. That'd be a staggering amount of business. Keep in mind, this is the one chip maker that comes close to rivaling NVIDIA, so 10% doesn't sound all that crazy to me. In terms of software, AMD is still playing catch-up, which is why they've made a number of acquisitions in recent years. As for powering AI everywhere, they're talking about AI PCs and gaming, plus things like robots. Management says they have a full ecosystem that covers all of these capabilities. But while all of that's impressive, the biggest news last night was AMD's new long-term financial targets. Targets that they blew your mind. They were much higher than anybody was expecting. And that's really what sent the stock into the stratosphere today, the targets. First, management offered some remarkable growth targets for the next 3 to 5 years. They say data center AI revenue will rise at an 80% plus compound annual growth rate, with the total data center business growing at a 60% clip. Overall, AMD expects its revenue to rise at a 35% compound annual growth rate for the next 3 to 5 years. There are not many companies that have anywhere near that. At the same time, management had some great things to say about profitability. AMD expects its gross margin to rise from 54% this year to 55 to 58% over the next 3 to 5 years. Again, staggeringly good. They see their operating margin rising from 24% this year to 35% in 3 to 5 years. Then AMD projects it can earn more than $20 per share. $20. You can see that's not expensive stock within the next 3 to 5 years. Given that they're expected to earn less than $4 per share this year, that's going to be stunning growth. Of course, it's not just that AMD rolled out very bullish financial targets. It's also that the targets, they seem very credible. Take that $1 trillion total addressable market figure for the data center. Seems crazy, right, at first glance? But as Ben Reiches from the Melius research firm points out, AMD was the first company to issue what he saw as a cartoonish forecast for the data center back in 2023, when it projected the total addressable market for AI semis and network equipment will be worth $400 billion by 2027. I remember when she made the projection. I think a lot of people laughed. But now it's widely believed that this forecast was way too low. Righteous thinks that AMD's $1 trillion forecast for 2030 may also end up being too low. I think you could be right. With the numbers that AMD presented last night, you almost had to buy the stock in response, especially if you're running a hedge fund. I mean, I'm not at all surprised to see AMD soaring today, because these numbers were so good that the analysts were forced to raise their estimates significantly, which translates into higher price targets, which translates into higher stock prices. Still, can AMD stock keep running? For the past couple of weeks, I've noticed that there's been a shift in Wall Street sentiment. Investors have gotten more discriminating when it comes to the AI stocks, with more focus on who actually has the ability to deliver on their grand promises, means making money. Which brings me back to the financial projections from AMD. These numbers are to some degree an extension of the OpenAI partnership that the company announced a month ago. At the same time, we didn't have many specifics about what this would mean for AMD's sales. Now we kind of do, along with some bullish new information on margins and profits. But all of these long-term targets are contingent on AMD doing a lot of business with OpenAI starting next year. If you believe OpenAI will honor all of its commitments, or can honor all of its commitments that it's made, the numbers are doable. If you don't believe it, though, then the numbers become, let's say, very stretched goals. Here's the bottom line. Going forward, the story of AMD is all about execution. The stock's already roared in anticipation of phenomenal growth in the data center. Now AMD needs to actually deliver. I think Lisa Su and her team deserve the benefit of the doubt, because historically they've done a great job. But it's still something we need to keep an eye on. That said, given her multiple years of success at AMD, I am more than comfortable telling you that even up here, you can buy her stock. Let's take some calls. Let's go to Mark in Nevada. Mark.
Hey, Jim, booyah.
Booyah, Mark. What's going on?
What's going on? Calling about Micron today. I've seen a lot of solid record of positive earnings and surprises, good momentum behind the AI trend. I think they got a good business model. I got in at a good price point. I'm just wondering, fresh highs, where do you think this is going, and how do you think Micron's going to end up in the future?
All right, Mark, it's a great question. They do have this one business called the high bandwidth memory, and that is data center, and it is on fire. Sanjay Mehrotra said that could happen. I'm not saying there's no stopping Micron. I am saying the Micron right now is on a high level run rate that is going to produce earnings for at least the next year that are going to surprise people. So I think you've got a good one. I think AMD stock will keep going higher if it executes well, and I'm willing to give Lisa Su the benefit of the doubt that she can deliver on those goals. Much more Mad Money ahead. Couldn't much sit down with Databricks. The software provider has been riding the AI wave to new heights. I'm getting a read on what's next for the private player with the company CEO. Then, is there ever a right time to sell a stock you own? I'm breaking down my thought process around exiting a winning position so you can stay ahead of the market. And of course, all your calls. Rapid fire, tonight's edition, the lightning round. Jim Cramer. Look, everybody talks about all the business being done by OpenAI. I get tired of that. It's not the only privately held artificial intelligence play with surging revenue growth and a booming valuation. Take Databricks, the data analytics and AI software company that helps its customers store and harness their data. 2 months ago, Databricks raised $1 billion in a funding round that valued the company at over $100 billion, up from $62 billion less than a year ago, and a lot more than we've had the company and followed them for a long time, the old days. The company also disclosed that it surpassed a $4 billion run rate, up more than 50% year over year, including $1 billion run rate for its AI products. Databricks, it's going cash flow positive. So what's the secret to the success? Let's check in with Ali Ghodsi. He's the CEO and co-founder of Databricks to find out. Mr. Ghodsi, welcome back to Mad Money.
Thank you so much.
Okay, so Ali, you got to help us. Everyone talks about all the great things that they're doing with AI, but I need to go to the ground floor. I need to go to the lake house, so to speak, to the person who can tell me if people are using it right, how they're using it, how they're interrogating the data, and are they getting the most out of it? Because I got to believe that they don't really have someone like you at their own places to tell them.
Yeah, it's very interesting that you actually ask. So I think there's been a lot of focus on superintelligence,
right,
and building the smartest AI possible and asking it the hardest AI math questions, programming questions. But what we really need is for the AI to do mundane tasks, kind of boring AI.
Right, thank you.
Like extract this field from ServiceNow and enter it into Salesforce and do some, basic summarization on it. So we have really been focused on how do we really make sure that the agents can reason on these simple, mundane tasks. So that's why we built Agent Bricks. And there our focus is build evaluations that evaluate everyday tasks, not the hardest math questions, but just how do you just extract this field? How do you enter that?
And I think it's important to point out that you'd make a lot of money if they keep asking those questions. It's just not a valuable use of your time and not valuable use of their money, correct?
Exactly. So you just need to take the tasks, and actually my joke is take the simplest task in a company, the ones that are the easiest to do that we're having humans do, and just augment them today with Agent Bricks. And that way you can move up, then get more and more ambitious over time. But let's start there, and we're seeing a lot of success.
Now, to me, the way you're describing it is the simple way to be able to say, no, you're not going to lose your job. Yes, you actually may be better at your job.
Exactly. I mean, it's literally a competition, right? At every work, you get evaluated. You get performance evaluation every year at your company. Your coworker will start using the AI. They'll be more effective than you. So can you take the most mundane parts and automate those away, the toil, so that you can actually do more interesting things with it? A lot of the super, intelligent AIs, they can't do these mundane tasks. So just our focus has just been start there, and we're seeing great results. We're saying one of my favorite examples, AstraZeneca. AstraZeneca was able to actually sift through 400,000 electronic medical records that then they used for clinical trials. You could not have had a human being sift through 400,000 documents. So this is making the clinical trial research team much more productive. So that's a super exciting use case for us.
Okay, last night I went to a very tough event where a friend of mine was honored. It's the Lou Gehrig Foundation. This is for ALS. They don't have as much money as I thought to be able to analyze it. There's studies that have been done all over the world. Would Databricks be able to say, listen, I want to pull the studies rather than painstakingly have to pull each one and figure out what each one says?
Yeah, it's early days, but yes, we're now seeing, Merck built a model called Teddy, which uses transformers. And you can now actually start to see the AI is seeing the relationship between genomes, the genetics and the phenomes, the diseases, and also now the cell involved in causing these diseases. So it's actually helping drug discovery. It's helping actually working towards curing these things. But it will it's still a big challenge, but it is having a dent.
Now, a lot of people use this word that people say to me, Jim, what does it mean? I'm going to give it to you. When people say they train their models, that's actually you that trains the models. Could you tell us what that means?
Yeah, it just means that the AIs that already we can get from OpenAI, Anthropic, Gemini, those are all, by the way, 3 big partners of ours.
Right.
Those understand everything public on the web. They understand. You can ask them about anything that you can find in any book. But inside of the enterprise, there's a lot of proprietary confidential information that the AIs do not have. So we can train these existing models to understand, to start operating on that proprietary confidential data they have within the enterprise so that you can do things like that drug discovery that I mentioned, or going through those electronic medical records that are very sensitive. So training just means, can you adapt the model, the existing AIs, to give them the context so that they can understand the sensitive proprietary data that the enterprise has.
Now, one of the things I love about you is that it's not like I just have one set of data. You're agnostic. You really do allow people to go everywhere, correct?
Yeah, we're multi-cloud, so we exist on all of the clouds. We process all kinds of data, all the way from completely unstructured data. This could be logs, this could be customer transcripts, it could be voice, it could be structured data that's sitting in tables about revenues and SEC filings. And most importantly, we're multi-AI. So whether you want to use OpenAI or Anthropic or Gemini, or if you want to use the Chinese models, if your organization allows for that, you could use those, the open source ones. So we give you that kind of control.
Well, okay, just help me. We're close to Cloudflare, and they tell us that there are some sites that are scraped, that are really proprietary, and they need to get, and they should be paid. How do you stop organizations from saying, okay, look, I want to go into this place, even though I know I'm supposed to pay and I don't want to? What do you say to them?
Yeah, well, that's the existing big models, right? The big labs. We just leverage those existing models and train them on proprietary data that we do have permission to do. That's the problem of when they train these AI models that understand the whole web, which websites are they going to, and do they have rights? And that's a really interesting question. I think that we will have to figure out a way so that both the people that create the websites get paid, and also traffic will be redirected towards them. But at the same time, we also do need the AIs, to have this intelligence. We're not going to, if the AIs can't train on all of the data, then they're going to be really dumb, and then we can't do anything with them.
Right. All right. Now, one last thing. I know that it's a tricky question, but from the day I met you and started talking about you when I go out to Dreamforce, everyone always says one thing, which is that, you know what, these guys are going to make a lot of money, and you want to get a piece of it when it comes public. Now, it hasn't, and maybe you don't even need to. And that's sad, I think, for a lot of our individual investors. I'd like them to buy a couple shares of Databricks and put it away, because you are cash flow positive. You make money.
Yeah.
And that's better than a lot of the other companies that people are betting on as opposed to investing. Thoughts?
Well, I mean, first of all, I think we announced a partnership with Robinhood Ventures. And, I think you can. Actually, there is a way to get a piece of Databricks.
So you really would go that way?
Yeah.
Because I like what Vlad's doing.
Yeah, I think it's excellent.
People are saying, that's top of the market. I don't think that's true. I think he's letting individuals into some good companies.
Yes, I think it gives access to companies like Databricks, which is excellent. So we're very, very excited about that. And they're also a big customer. So, we'll partner with them closely. But, we will be public.
Right.
Databricks will go public. I just don't know when.
All right. Look, you've always been great with the answers, and you're a great explainer for people. And one of the reasons why just people know I ask him the questions is because he's agnostic. He's not trying to steer you to anyone other than to the truth. That's Ali Ghodsi. He's the co-founder and CEO of Databricks. Ali, really great to have you on the show as always. That money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
girls, we say the stock buy, sell, that's my step. You plan this out, and then the lightning round is over. Are you ready, Ski Dad? Come to the lightning round. We'll start with Mark in Florida. Mark.
Yeah, hi, Jim. It's Mark from Miami. I got a question about Doximity. I bought it at 71. I'm trying to stay disciplined and had a good quarter. I'm not sure if I should sell it.
No, it's still too expensive. And I didn't think the quarter was as good as you think. I was actually surprised that this stock ever got as high as it did. I want to wait on that one. I do not want you to buy it here. Let's go to Luke in Arizona. Luke.
Mr. Cramer, how you doing, sir?
Good. How are you?
Hey, good. Hey, I'd like to just say happy birthday to my dad, Dwayne Adams. He watches your show every day, so
I mirror that. I echo that. Birthday booyah. What's
Thank
going
you,
on?
my friend. Thank you.
Thank you.
So my big stock I'm calling about is Iron.
Okay, so Iron's a press release stock. It's great that they won a big deal. I think that's absolutely it's super. But that is part of the year of magical investing that's ending. So I say you'll never regret it. Sell half of it, okay? Let's go to Steve, New Jersey. Steve.
Hey, Jim. Hey, just want to say I've been listening to you for over a decade now. You've become the best financial advisor I ever had. And I can't thank you enough. Great
Thank you. That's great.
In 2020, praise is never something you get tired of.
Thank you, man. Thank you.
In 2021, with your positive input, I bought Boise Cascade. I sold it last year at a nice profit, and when it continued to bounce back and forth between 119 and 150 approximately, I bought it back the next time it hit 119.
Okay.
Now what? What's going on with the company?
Well, I mean, look, the problem is connected to housing. Anything connected to housing is just bad. We have to see the Fed cut rates. If the Fed cut rates, I'd rather see in one of the major big box home companies than I would see Boise, because Boise's too levered to only a certain part of the food chain. I'm sorry. Let's go to Maury in South Dakota. Maury.
Booyah, Jim. Thanks for taking
Booyah.
our calls.
Of course.
I'll be lightning quick. With the housing market stuck in the mud and the white-collar consumer in question due to the rapid advancement of artificial intelligence, what do you see in the short to mid-term for this long-term strong buy stock? Do we buy here or wait for a better entry point? QXO.
All right, that's Brad Jacobs. Brad Jacobs is going to find a way to make money. Now, I personally do not think the roofing business is that good. He'll consolidate. He'll do something special. He'll come on the network. He'll look really smart because that's who he is and what he does. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, when's the best time to sell a stock in order to make a solid profit? Cramer's giving you his take and some red flags to watch out for. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
There are a lot of people who say, I made a lot of money off your Rigetti recommendation. And I'm like, what are you talking about? Yeah, Rigetti. Yeah, no, I didn't recommend Rigetti. Oh, yeah. Yeah, on March 23rd, you said Rigetti in the lightning round. Well, I'm not recommending Rigetti, okay? I'm not. Period.
It all starts at 9 a.m. Eastern.
Booyah, Jim. I love you, man. I've been watching you from day one.
Thank you for all the wonderful advice that you provide us.
I'm learning so much watching your show. Watch your program every day. I love it.
Always wanted to say booyah on your show.
Thank you for being the greatest in the world.
We consider you the money market maker, and we thank you for all you do.
I love your show. I'm a long-time fan of your show, and we think it's the most entertaining program on TV.
Look, there are a lot of reasons not to ring the register on a stock where you got a big win. First, you're incurring taxes. Nobody likes paying taxes. Second, in many cases, you're interrupting the power of compounding. And compounding is the best part of owning a dividend-paying stock. Third, you're trading. And I think that trading is a sucker bet unless you're doing it full time. But on the other hand, there's only one reason to sell a stock. You sell because you want to lock in your profits. After all, you don't have a gain until you take something off the table. That's so often forgotten or is blotted out by greed that leads ultimately to unexpected losses and defeat. I bring this up because I'm getting some heat about my newfound position that you should invest in profitable companies, a necessary step back from the year of magical investing. I'm backing away from the unprofitable ones because I saw what happened in 2007 and the dot-com collapse in 2000. I don't want to go through that. I don't want you to go through that. You only need to get rich once, people. But you can't get rich until you ring the register. We do that all the time now for the Charitable Trust, which you can follow along. We got tomorrow's noon investing club meeting. I'll probably have to talk about this. Small trims to take our own cost basis out so we can play with the house's money. Let me give you some examples right from today's headlines. Maybe you bought Oklo because I've spoken highly about nuclear power. Oklo is working to develop as much nuclear power as possible with smaller form reactors. And the conference call yesterday was extremely bullish and really good. At the same time, though, we got to admit that Oklo is a pre-revenue company with gigantic losses. Even if the federal government starts greenlighting nuclear projects faster than they're doing now, it can take a decade to build one of these things, and they always seem to have huge cost overruns. Sure, Oklo could announce a deal to provide power with a major hyperscaler, but who knows when that will come, and in the interim, the stock is up over 400% for the year. As I see it, this more than 400% move is giving you a terrific opportunity to ring the register on part of your position. Now, ideally, you can take out at least your cost basis. Then you can let the rest ride. I'm not against that if you're still a big believer in nuclear power like I am. But, man, it's over 400% for the year. Again, you only need to get rich once. If you want a safer way to go in nuclear, by the way, I like this processing division of Solstice, the Honeywell spinoff, which has a full order book. That's a cheap stock. Or take Rigetti. That's the quantum computing company just come out of nowhere with a stock that traded just $1.49 a year ago. Now it trades at 28 and change, although it's traded as high as $58 last month. Too late to sell at this point? Even after today's nearly 10% beat down, Rigetti's still up 85% for the year. Meanwhile, the company itself has got declining revenues, losing gobs of money. That doesn't sound like it's too late to sell to me. You think it's going to come right back? Okay, how about this? You sell half of it, playing with the rest of the house's money. That way, if you're right, you still make out like a bandit. But if you're wrong, you can only lose what you can afford to. Why do I keep urging caution here? Look, I've said it over and over again. When I begin to see a pattern of insider selling, I'm going to flag it to you. Both Oklo and Rigetti have seen insider selling, even if it's mostly of a 10b1 plan, the kind of sale that automatically happens irrespective of price. Some discount these plans because they're pre-programmed. Say, people aren't taking advantage of the news flow. As someone who set these plans up myself and then did them myself, let's just say you're done. You do these because you want to lock in gains. You want to sell stock and you don't want to be in trouble if there is news flow. But let me tell you something. A sale is a sale, and don't you forget it. So if you crave quantum computing in your portfolio, IBM's got commercial quantum. That's selling really well. Much safer way to go. Rigetti and Oklo are just two of the hyper-speculative companies that I'm referring and referencing when I am talking about the year of magical investing. That era is drawing to a close. If you own them and they're up very big, have you made money? Only if you sold some. Otherwise, no. Otherwise, those are phantom gains that could disappear in a heartbeat, and you will have very little to nothing to show for your effort. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.